the next chart from Bespoke is so insane. Ex-gas retail sales are back to record highs.
Yes.
So what recession?
I know. They said it's 1% above where it was in January. So retail sales are basically back on the long-term trend, which
By
is...
the way, tracking the stock market. Positive, S&P 500 positive year to date.
I keep coming back to this. The stock market is smarter than everyone else. This year, I think the stock market is way smarter than everyone. All of the really smart people who are saying this detached from reality, it doesn't know anything. The stock market...
Are you subtweeting me to my face?
Oh, yes. Because I tweeted a couple months ago, it's going to be really awkward when the stock market is at all-time highs this summer, and you tweeted me back a picture of a moldy burger and said, this tweet is going to age about as bad as this.
This is a chart. This is a good one.
Oh, I thought you were going to explain this next chart here.
No, I'm just saying this chart that we're showing is a great chart, no?
Yeah. Yeah. You want me to give you a pat on the back for it?
It's not my chart. It's a good chart.
You want to take a step back and just like appreciate it for a second, like a piece of art? Like, yeah.
Honestly, I was gazing, and it's just a good looking chart. All right, the next chart. This is
Can we stop it with the acronyms? Look at this acronym, FAAANM. It's got FAAAANM, like FAN. That's not an acronym.
So what's with the 3 A's? Apple, Amazon.
People are
Who's
doing
the third A?
alphabet for.
Oh, that's right. Duh.
Anyway.
Okay. So what this is showing is employees per $10 million in capitalization. And we've spoken about this, I think, several times over the years. How could this not affect multiples if companies can be so much more efficient with their labor?
Well, didn't you do one back in the day where you compared like U.S. Steel to Facebook?
Like I think I did sales per employee, something like that. And so right now, the FanM companies have been pretty much steady at, it looks like 2 employees per $10 million in capitalization. But the S&P 500 has crashed, which is a great thing for investors, not necessarily a great thing for everybody, though.
Right, for employees and...
Yeah, like being able to do more with less is, that's one of the amazing things about technology, but it's also one of the terrible things about technology is that people are getting replaced.
You know what the best form of UBI would be? I mean, obviously giving people money is really helpful, and it's shown to work for this whole thing.
Yes, buy them FanM.
Everyone, when they're born, needs to get like $5,000 in their name in a total stock market fund. I think, honestly, if people would stop being so mad at the stock market if everyone was involved in it somehow, even in a little way.
I earnestly agree.
Okay, I'm going to quote Michael Batnick here. America's first billion-dollar corporation was U.S. Steel. In 1902, they employed 168,000 people and had sales of $561 million.
Did I adjust for inflation?
3,300 revenue per employee, 90,000 in today's dollars.
There we go.
Today, U.S. Steel's revenue is 493,000 per employee, or 5.5 times the amount it was in 1902.
So there you go.
Yeah.
Is that company even worth $1 billion anymore?
That's a good question. I don't.
Let's see. I mean, I'm sure it is, but how many billions? Oh my God, 1.7.
Wow. That's pretty crazy. So it was $1 billion in 1902, and now it's still roughly $1 billion.
Nominal $1 billion in 1902.
That's kind of amazing that it's actually still in business that long. That's more.
Not buy it. The lesson is do not buy and hold U.S. Steel.
Just sticking around that long is impressive, though. Okay.
All right. So
can we do Michael's weekly sentiment trader Stan account real quick?
I'm just saying he does good work. So what is this showing? This is showing the percentage of S&P 500 stocks in correction. Hang on. Let me just go right to the source. So the S&P 500, he said, the S&P 500 just moved to within 5% of a 52-week high. You with me? More than 60%.
Pretty sure I called that. Just saying.
Called what?
That we were going to be at all-time highs eventually. You
did call it. More than 60% of stocks in the index are more than 10% below their own highs, which hasn't happened since ... September. I added that ... September 2000.
Wow. So everything is really close to being in an all-time high again.
The index, but not the stocks.
Okay. But within 10% is pretty close.
Well, it doesn't say, no, it says 60% of stocks are more than 10% below their highs.
Oh, below. Okay, I gotcha. Oh, below. Okay. So there are still a number of stocks that are in a correction phase.
Oh yeah.
Okay. Interesting. which,
by the way, we spoke earlier. You said something like, "Shouldn't this be a great year for active managers?" Not at all.
right, unless they just were
If they're
heavily
in one of the-
overweight in.
Yeah, if they're in one of the big five, then yeah, they've done tremendous. So this next chart
But
shows.
can you imagine being an active manager and just saying, I'm going to buy in the weights of the NASDAQ 100. So I got 10% in Apple and 10% in, like 50% in those 5 names. Your investors would say, get out of here, you're crazy. Right? If you would have handed them that portfolio 5 years ago or whenever, like people would have said,
Oh yeah, they would say,
why
why am I paying you for that?
Right.
I could just buy the NASDAQ 100. This next chart is from Deutsche Bank, showing the S&P 500 mega cap growth versus all others. This is a chart too. Pretty easy on the eyes. So index to 100 starting in, is this January 2020. So mega cap growth looks like it's up 35%. S&P 500 X mega cap growth is down 6 or 7. No, I'm sorry, down like 12 or 13%.
I believe in technical analysis school, they call this bad breadth, right?
Yes, this is quite a divergence between the two groups. Unbelievable.
It's just the weird part is we're seeing these relationships like they were in the tech bubble, but during the tech bubble, they didn't make any sense. Like none of those companies were making money. These companies today are all making money. So it's really hard to wrap your head around the fact that this does and doesn't make sense at the same time. Right?
Well,
it's like
these
it's
are the
both.
biggest. These are the biggest beneficiaries. These companies are performing incredibly well. However, that was true always over the last 5 to 10 years. What's happening now is their multiples are going up and up and up.
So this was from Bloomberg. 40,000 Robinhood accounts added shares of Tesla during a single 4-hour span last Monday, I believe it was, according to Robintrack.net, which compiles data from Robinhood. We've said a lot on this, but it's that's a lot.
Oh, there goes Tesla. It's going up again. Up 7% today. So it had a hard correction. What do
you consider a hard correction? How far was it down?
I don't know, 15%.
Okay.
Was it? I don't know. I'm just eyeballing it. It went from a high of 1,800 down to 1,430. Unbelievable. What a stock. Would you say that this is the craziest stock of the last decade? And there's not even... Who would even be number 2?
I don't know. I mean, there's been a lot of mini bubbles, but this one...
What would even be number 2?
I don't know. This one definitely takes the cake, though. I agree. It's wild.
So 40,000 accounts. All right, good for them. They're up.
Yeah, and
hope they have stop losses in
4 hours. So Eric Balchunas tweeted, retail trading as a percentage of volume has gone from roughly 10% to 19% since 2010.
That's a lot.
That's a big jump. So retail is in it, and it's been slowly going up each year. And obviously a lot of that has to do with costs coming down and the gambling mentality and all that stuff. But so out of all these groups, retail is now the biggest. That's pretty interesting. So it's almost double what hedge funds are. Hedge funds have actually gone down a little bit in the last few years, while retail has increased.
So Robinhood is a new renaissance.
But that's the interesting thing is that the reason that was good. I'm sorry. You're really looking for some compliments today, fishing.
Well, I had a lot of caffeine before the show.
I really bought into the idea that there's fewer suckers at the poker table, and that's why it's harder to outperform. Those suckers,
no longer the case.
Those suckers have come in.
They're back.
But is it possible that those suckers are a little more informed than they were in the past?
Time out. Time in.
I mean, maybe in the past, people were momentum traders with a value investor's time horizon. Now they seem to be momentum traders with a momentum trader time horizon, and maybe they're not getting clipped quite as bad as they once were. Is that possible?
Yeah, we have no data on this. I'm just making this up, but I feel like I am making this up, so I don't know where I'm getting this from, but I get the sense that people aren't buying a giant winner and then riding it all the way down. I guess maybe the reason I'm getting the sense is because nothing is going straight down. So I guess we'll see, is what I'm saying. We don't know. We haven't seen the other side of this, if there is an other side.
Right. So is it possible people are, cutting their losers a little faster and following some of these old trading rules?
I don't know. Is that possible? If and when this turns, they're going to hang on. Let's be real.
Yeah. Oh, yeah. There's going to be some huge losses, and especially if we see another downturn.